Let's be honest. Deferred tax is the reason accounting students switch majors to marketing. It is the single most annoying concept in the financial reporting universe because it deals with imaginary money. You look at your bank statement, and the money is there. You look at the tax bill the government actually sent you, and you paid it. But then, IAS 12 walks into the room wearing a cheap suit and whispers, "Yes, you paid the tax bill, but did you pay enough relative to your own EVO?" It forces you to record a liability for a bill you have not received yet, or an asset for a refund you cannot touch. It feels like gaslighting. You want to scream, "Cannot we just record what we actually paid?" The answer is no, because auditors are sadists who don't want you to be happy. To survive this without drinking the toner fluid, you need to stop thinking about tax codes. Think about the bar tab versus the pregame. Scenario A, the Deferred Tax Liability, or DTL. Imagine you are at a bar. You order 5 expensive cocktails. You drink them. You enjoyed them. Your reality of IFRS. I have consumed 5 drinks. I owe for 5 drinks. The bartender, the tax man, he is lazy. He only marks 2 drinks on your coaster right now. You have cash in your pocket because you have not paid for the other 3 drinks yet. But you are not richer. You cannot spend that money on a kebab. You have a deferred liability. The bartender will remember the other 3 drinks before you leave. Scenario B, the Deferred Tax Asset, or DTA. Now imagine a different night. You are paranoid about losing your wallet, so you shove $100 into the bartender's hand immediately upon entering. Your reality of IFRS, you have not had a single drink yet. Your expense is 0. The bartender, the tax man, he took your cash. He considers that money paid. You are currently sober and broke, but you have a right to future drinks. You have a deferred asset. You prepaid for the pain that is coming later. IAS 12 is all about the difference between the carrying amount, what you say the asset is worth, and the tax base, what the taxman says it's worth. Deferred tax liability, the pay later trap. This usually happens with property, plant, and equipment. In your books, you depreciate a machine slowly using straight line over 10 years to keep your profits looking good. The tax authority, however, offers accelerated depreciation to encourage investment, letting you write off the whole machine in 2 years. Your taxable profit is low now, so you paid less tax. Your accounting profit is high due to low depreciation expense. You saved cash today, but you used up your tax deduction. In the future, you will have high profits and 0 tax deductions left. You will get hammered. Deferred tax asset, the save me for later coupon. This usually happens with provisions, for example, warranty claims or lawsuits. You follow the prudence concept. You think you're going to get sued, so you book an expense now. The taxman says, "I don't trust you. I will not give you the tax deduction until you actually pay the cash to the lawyers." You paid tax on profit you claim you did not make. When you finally pay the lawsuit in 3 years, the taxman will finally say, "Okay, now you get the deduction. You have a coupon for a future tax break." Here is the hard truth I tell my junior accountants when they bring me a balance sheet that does not balance. Deferred tax is the price of consistency. Without IAS 12, your post-tax profit would bounce around like a rubber ball. 1 year, you would pay 0 tax thanks to accelerated depreciation, and the shareholders would think you're a genius. The next year, you would pay massive tax, and they would fire you.